A lot of you guys have completed a rapid concept workshop with Appster, which is awesome because that's the most important, vital part of development is the actual strategization of the product. But a common objection or a common hurdle that we actually commonly see is getting that initial startup capital. Now, we actually are lucky enough to have McDonald here, one of the co-founders of Appster.
Thanks. I'm excited to speak a little bit more about this topic.
Yeah, man. So look, tell me, like a lot of people out here really, they don't understand how to actually get that initial startup capital. They've got a great idea, they've got the strategy, but look, can you give a couple examples now? There's about nine ways to raise capital.
Yes, there is, Dane, and I think that for different startups, there's different benefits for different kinds of ways of raising capital. Okay. So what I think that's really important is actually trying to find the right type of capital for the kind of stage you're at and also the kind of product you're trying to create as well. So I guess that we'll work through a couple of different ways we'll speak about, and if clients have any ideas about which ones are relevant to what they're trying to do, then that's great.
Yeah, awesome. Now, guys, if you've got a pen handy, I'll give you my direct email in case you do have any follow-up questions. It's Dane, D-A-N-E, at appster.com.au.
Awesome. So the first kind of investor, Dane, is obviously an angel investor. Now, what an angel investor typically does is that these guys are focusing a lot on, they're typically individuals or small groups of people that come together, and they're usually looking to put, between $10,000 to $100,000 into an idea. So these guys, they usually invest their own capital. You'll typically find in every state around Australia, there's different, different networks. For instance, there's the Melbourne Angels group, there's the Sydney Angels group, and they're traditionally business people that have had some success in business before. And then essentially the exciting thing is that they kind of think, well, maybe I can put some money into other businesses, and they're traditionally very interested in getting started at the early stages. Now, I would say that the really important thing when looking for angel investors is that you want to go after what we call smart money. Now, smart money is not just anyone can give you money. If you've got a fantastic idea or a concept, there's actually more money out there than great ideas. Yeah. But you want to try and bring on someone into the business that is actually going to add value to what you're doing. For instance, one of our clients recently, as you know, Blue Dot, brought on the founding CFO of PayPal. Now, he became not only an investor, but he also became a director in the company. And the value that he brought on there was, financial management, obviously, but also his connections in the industry. So often when you're looking and shopping around for lots of different investors, and my advice would be speak to a lot of different people. A lot of people don't raise capital because they don't speak to enough people. But you want to try and go after the people that will bring other value to what you're doing. Okay. I would say that the other important thing to know about angel investors is that typically they're looking for an exit in 3 to 6 years. And what that means is they're not looking to make 10% on their money each year. They're looking to make something, invest in something that can grow big. So if you're trying to make an app here that your goal is to make $100 a day or $200 a day, that's fine. I mean, there's nothing against making a product like that. However, what I will say is that that's probably not the kind of product an angel investor is going to take that kind of risk in. So typically they're looking for things that can explode, things that could get acquired by other companies, and they're looking for some sort of exit, whether that's a sale, maybe in an extreme case that's going public or being acquired by a larger tech company. So that's angel investors.
Yeah, cool.
Now, the next thing is corporate venture capital. Now, these guys are more long-term. Like they're not so dependent on the money that in the same way that an individual investor might be. Now, typically these are actually venture capital firms. Now, these guys actually look after a large amount of money in a fund, and essentially you can think of them as money managers. Now, they're typically looking at an exit within 10 to 12 years, which is a bunch more time. Now, the way that they actually make money is they make money how they charge their clients is essentially a management fee of 1 to 2.5%, usually. So whatever money they have, they always focus on that initial fee. So they're very fee driven. However, on top of that, they're also looking to make 20 to 25% of the profit. So, for instance, if they make a $1 billion deal, like for instance, Secure Capital in the US recently made a bunch of money because of the recent WhatsApp acquisition by Facebook.
Yep.
They're getting 20-25% of that money.
Okay, now what is the actual main risk in actually taking on a VC?
So we'll continue. So obviously, corporate venture capital is a really interesting space, but I would say, like I was saying before, the big risk is in getting screwed over.
Yeah, exactly, and that's a lot of these horror stories that I hear, that venture capitalists will wait till you're on your last penny and dime, and then they'll really sink their teeth in it and try to take a majority stakeholder in the equity. Is that am I right?
Yeah, I think that's very fair. I think that they've got a different intention towards a typical angel investor or an unsavvy investor. These guys know, like, I'll give you an example. Like, traditionally, most accountants will say to you, structure your company so your IP is in one trust and the actual operational company is another. That's something in which a venture capitalist has no interest in operating in that kind of environment. Mostly because they want to control both. So if you're going, most people try and say, oh, I'll just give you equity in my operational company, I'll own the IP. So there's all these sort of things that lawyers and accountants do that venture capitalists are aware of. So I wouldn't say they're necessarily perhaps saying screwing you over is the wrong thing, but they're certainly very savvy, and the kind of contract negotiation that is quite intense. Now, the other thing you've got to be aware of as well is the due diligence that venture capitalists do as well. Like, I wouldn't say you shouldn't be going to a venture capitalist straight away. And the reason that is because the due diligence phase, often they'll do this thing to startups and companies where they'll say, hey, I'm interested, I really like your concept. Maybe you'll go to lunch with a partner, then you'll meet a more senior partner, and you'll meet some really, really interesting people. The problem is, of course, that this process of due diligence, where they're meeting you, asking for numbers, asking you to put together and review their contracts, before they've even put a term sheet on the table, it can go on for months and months and months. And a lot of founders actually say, that actually really takes away the focus from their business. They spent, 9 months going through this due diligence process without even terms on the table, and then all of a sudden the VC said, sorry, not interested anymore, there's too much risk in that industry. So our advice there is to always negotiate with a VC only do due diligence when you have a term sheet on the table, when you have an offer.
Now, in terms of deliverables, because VCs are inundated with many requests on a daily basis, so what sort of deliverable would someone in basically everyone listening, someone with a concept, a good idea, they want to get an app developed, but they don't have like a working prototype and so forth, how can they prepare for the meeting with a venture capitalist?
Yeah, I mean, we've had a couple of clients actually even fly out to Silicon Valley to pitch to VCs and such. And I think that the thing is that most people get intimidated by venture capitalist funds. And I think that, and VCs in general, I think that they're always, Secure has this policy where they're always very open to meet with people. And that's the case, both in the US and, recently I was spending a bit of time in India as well. They're always open to catch up with people, always open to meet with people, and they'll hear your idea. They really will. I guess it also comes down to the value proposition, where you're at. A lot of people will talk to somebody when they've just got an idea, they have no momentum, and that idea, maybe it's worth $1, but then they go to them with a business plan that's worth $2, and then they'll go to them with an actual prototype and that might be worth $3. And if you go, these are all relative numbers, of course, but then the most valuable thing is when you have full working software, and the most valuable thing above that, of course, is you have a successful business that's already making money and doesn't even need their money. And when you're at that level, that's when you can really only give away a small amount of your company at that stage. So I guess it comes down to how far can you get down that value chain before you have to bring in an investor like this. And to be honest with you, my recommendation is not to really go after venture capitalists, because these guys, unless you're at that stage after Series A, these guys are not really looking for deals that are often less than 100, 200 grand. A lot of the time they're trying to invest millions because they're trying to do deals where it's just not worth their time. They're managing such large amounts of money. I also think that the VC community in Australia is not as developed as other parts of the world, which is why a lot of clients and a lot of people I know actually fly across the Silicon Valley and places like that to pitch firms.
Cool. Now, look, I'm actually interested in corporate venture capital as well, so CVC for the people at home.
Yes. So there's a lot of companies, and we'll talk a little bit about this, and we'll give you guys some specific places to go because we're really just talking high level here. But there's some really great examples of, you know, companies like Telstra and a lot of innovation funds where they're large established businesses, but they recognize the need to be innovative and disruptive. So whether it's a formal program like the Telstra Innovation Fund, or whether it's something like ANZ Innervise, where ANZ is actually working with the Innervise program and sponsoring and taking equity in startups. Strategic investors and corporate, if your idea aligns well with a big industry, like for instance, let's say you're trying to make a new, 5 or 6 years ago, you're trying to make a sort of an app in the space of taxis, and then you go and speak to a big taxi conglomerate. That's the kind of thing where you can essentially go in there and you can pitch them on the vision of what you're trying to create and perhaps get their support. Now, the great opportunity for this sort of thing is that it allows you to have that exposure to an existing larger market. And by the way, this is the exact same approach that one of our clients, Blue Dot, did. These guys actually went and got investment from a major bank because they were in the payment space. They got ANZ involved as a stakeholder. And corporate sponsors, it's really a matter of thinking like, what I'm creating, what's really important, what is the value that is being provided. That the disadvantage of a corporate strategic investor, of course, is the bureaucracy. It's the exact same problem that enterprise salespeople talk about, in that there's so many stakeholders. So you really need to establish who are the right kind of people to talk to. The bigger the company, obviously, the more money they can put in, but also the more risk it is. So I would really be thinking about, what your product, who are the kind of investors in corporate land, directors that would be able to put in some money because, either number one, this product is something that would enhance, it's a complementary offer to what they're doing.
Sure.
Or second of all, it's something disruptive that if it takes off, it's going to be really pretty scary for them and they want to control it from the early days as well so it doesn't put them out of business. Yeah,
that's fair. Now tell me, man, what is the relationship, the marriage between venture capitalists and let's say venture lenders?
Yeah, so I think that in terms of this is also something a little bit further down the line as well. Venture lenders typically are actually offering you debt financing. So basically, they're going to be charging you an interest rate, and they can negotiate to take back a percentage of the shares. So usually these kind of options are very much driven by cash flow predictions, even what actual equity you have. So they're going to be looking at people making personal guarantees and things like that.
Okay.
So I like I said, these are more kind of long stage things. Some of the other options we're going to talk about later in the presentation are probably more appropriate. So for instance, if you're already cash flow positive and you don't want to give away equity, going to a VC or actually going to issue things like bonds, for instance, you can actually, what you can do is you can say, instead, Dane, I need $100,000. Instead of going to a bank, I'll go to you. You give me the $100,000, and I'll actually pay you, 5 to 7% more on average than the market. So say the market rate right now is 10%. I'm going to pay you back 17%. And the reason companies usually do that is because they're at this awkward stage where they're trying to finance growth, and they might not be able to get that from a bank. But also these kind of guys, they also want to have an option to buy the shares if they choose to as well.
To take a chunk of the equity.
Yeah, absolutely. So I think another really important thing is the late stage founders. You're at a stage where your app is really taken off. You're starting to become like a WhatsApp. You're starting to become a Facebook, etc. So there's a bunch of places that and we won't speak too much about these. We'll just put them in dot points. And the main reason that is because most people on this call are not really at that stage yet. So, private equity investment, hedge funds and mutual funds, the big money, private markets, those kind of places, they're typically looking to invest, tens of millions or millions of dollars into a project.
Okay, cool.
Now, some actual like pragmatic stuff for the kind of people who are just on this call and they're just like, I've got an idea, how am I actually going to get it funded? Because I think that is really where the majority of value is going to be on this webinar.
100%. Yeah.
So there's government grants are really interesting, and here's some links that you might want to check out. Business.vic.gov has a bunch of different grants and assistance. For more information, you can click those links. The New South Wales government has two particularly interesting ones our clients have gone for, which is the Interactive Media Fund. It goes for 3 years, and the grants are based on applying for them, obviously. And there's also the Collaborative Solutions Problem. So they actually pay up to 25% of project costs, up to $100,000. But the whole idea is they should be something which actually identifies, it's got to be some sort of technology that's going to help build the New South Wales economy. So that's something you really want to be focused on when making a pitch in the Collaborative Solutions Fund. But, this is, whilst it's not capital up front, you're getting, 25% of your money that you're investing in something.
Okay.
So,
now, what sort of key sectors would fall into that criteria?
I think that's always something that is going to change. So, things like perhaps healthcare, I guess it depends on different focuses of different governments and even the grants. So it's always a good idea to give a call up to the grant programs and let them, usually they have a manager or a key contact. And it's really important that you kind of establish what they're looking for. And a lot of the times, you might not even be speaking to the one person. There's literally a board of people that will be making the decision. So it's really important to ask them those questions. It's a great point. What are you looking for? What have previous investments actually all had in common?
Yep.
And when you have that kind of information, that's when you can really, write a really kick-ass proposal and put that through. And they're the kind of grants that get funded.
Now, just in terms of the Interactive Media Fund that you mentioned before, you mentioned there was a 3-year initiative. Can you explain that a little bit more?
Yeah, so essentially the grant actually lasts, I believe, my understanding of that grant, and I would recommend that everyone actually goes and applies and check that out in more detail, because obviously we're just looking at a high level here, but it is current for 3 years. So it's something that there's a certain amount of money set aside, and they constantly, reassess and go forward from there. But I think the best way to get more information about that would be to really have a look at actually the website. It would do much more justice than I'll be.
Yeah, fair enough. All right, now look, moving forward, let's take a little look at actual corporate money. So we've got Optus Innovate.
And we've got a spelling mistake. You can see we put this presentation together. Yeah, so there's a bunch of different places, and I think this is where you guys are going to get some great value from. These are some different places. Excuse me, I'll just close that down. Some different places where you can actually look at putting, potentially getting investment. So the first one is Optus Innovate. So these guys really are looking for giving investment up to $250,000. So that should be, really a great way to actually get your first minimum viable product out there. Mm-hmm. And it's actually funded by Optus. So they're looking for products that, that already have some sort of traction. So this is kind of like what we were coming back and talking about before, which is the value chain. They're not really looking for someone who says, I have an idea, for a recipe app, or I'm looking for an idea to make a fitness app. They're kind of looking for, someone that's already built traction. And building traction doesn't mean you have to already have an app already running, but it does mean that you need to have validated your idea. And that's what we talk a lot about at Appster. Like, you've gone through, you maybe perhaps built a Facebook page of fans up that are raving about this product. Perhaps you've gone and done a bit of market research. Perhaps you have a prototype. They're the kind of things. And once again, the website there is optusinnovateseed.com.au. And by the way, these are not like crazy impossible things to get accepted for. I mean, there's literally a couple of these which our own clients have actually, been successful graduates from as well, particularly the Innervise Start program as well, which we'll talk about in a sec. The next one is Artisan Capital. These guys is also an interesting one here. It's spun out of the ANZ banking group's capital markets. It's something that you want to check out on LinkedIn. There's a link there as well. The Innervise Start program here is basically they really are just looking for software at this stage, which hopefully you guys are all kind of focused on as well on this call. And this is the program that actually Blue Dot graduated from.
They initially give you seed funding. First round, I think it's 30 to 250K. They give you a little bit of money to start off with. They actually put you in touch with investors. The value of something like this is truly in the fact that they actually, not the fact that they give you a lot of money up front, because I believe, Dane, they only give you about $30,000 in the initial investment. It's really a small amount of money. However, the value is that they can connect you to so many other investors, and they've actually actively got the ear of a lot of investors. That's how Philippe got funded at Blue Dot. And I think someone was telling me the average product receives $1 million in Series A graduating from something like that.
Yeah.
So definitely something to apply for. It's a once a year input, and it's something I do think that the one catch here is that I think they want teams of 3. So if you're a one-person shop, it's probably not for you, and it's going to be something where I'd recommend get in there. If you've got a co-founder or you're a business guy, you've got a development guy, they're looking for cross-functional teams.
And what is the main reason for that, do you think?
Well, I really think that the kind of people that are successful in business, it's very rarely one person.
Yeah, that's right.
Because business is even especially in tech, it's such a really difficult thing. You've got the technical issues, you get the marketing issues, you need the business development sales guy, you need the product guy. There's a bunch of reasons why people choose to have multiple founders. And I think that's the director of that program has been very specific about making sure that they choose cross-functional teams. So let's keep going through these really quickly. The Macquarie Technology Financing. Basically, they're really focused on deals in which there's a high potential exit. Now, Muradi is basically a Telstra-backed venture. They give $40,000 up front, and they give a 6% stake. And the big benefit of these guys is that they really give you the additional services and networks. Telstra Ventures is a very interesting one as well, because basically, like the corporate. The corporate investors we were telling you about, actually going after, if you're doing a taxi app, go to 1-3 Cabs. If you're doing a removalist app, maybe go talk to Minimoves. There's a bunch of different strategic partners for different ideas. But Telstra Ventures they've actually set up a fund to invest in, ideas that potentially could be strategically valuable to Telstra. So that's some of the corporate money. Let's talk a little bit about the actual investors and different investor communities. And typically the way that these guys work is you actually go there and you can pitch them their idea, and it's usually they meet on a monthly basis, and there's a bunch of guys and girls that catch up and really, you have to have a PowerPoint. It's very, we won't talk too much about how to set up a presentation like that, because there's a lot of stuff online. I'd really recommend you look at Guy Kiyosaki's presentation style. He has a famous, I think it's a 7-slide pitch, 7 key things to cover, because I think a lot of people just get really drawn out about giving all the details, and that's not what really investors are looking for. They're looking for, is this a person I can invest in? Is this a good opportunity? And can I understand the risks and deal with them? Okay. So here's some examples as well. The angel group, like I said, the average funding is $50,000 to $500,000. The Australian Association of Angel Investors is here as well. iPitch is an online community that gives you a lot of options there as well. The Western Australian Investor group as well. Innovation Bay. There's a lot of these which will I think that you guys can have a look at as well. And if you're taking notes, I'd really recommend just taking some notes of these guys, and you can always Google them as well. But yeah, to sum it up, I think that the most important thing, and I tapped on this before, was if you're going to produce a product and a startup, investors are not always just looking at your great idea, because we hear fantastic ideas on a day-to-day basis. The biggest thing is what they're looking for, particularly at the early stages, which we're talking about at this end of the presentation. They're looking for the kind of person that can make a business successful. Yeah, that's right. They're someone who's really committed, and not only that, but they're looking for a cross-functional team. That's why ANZ Innervise is really big on that in their incubator program, in that they only really want people that are going to, number one, they've got cross-functional teams. They've got a technical person, they've got a marketing person, they've got a salesperson. But at the same time, someone that's really committed. It can't just be a part-time thing. And I'll also say that, you know, a lot of the times with this particular kind of capital raising process, people think that, you know, capital is like the magic answer. Like if I could just get 100 grand for my startup, I could build an MVP, and I could also put $50,000 into marketing. But then they just want to do it on the side, or it's a small project, it's not really important. I think it's really important to be committed to this and really build the right team around making this a product successful. Because if you can't do that, if you can't convince yourself that, let alone potential investors, they're going to be really ruthless with you as well. And that's why you know, a lot of investors don't really get along well with startups. And in fact, why a lot of investors are actually they don't even touch startups. They don't even say that, like, they won't deal with you until you're actually generating, you know, a couple of $100,000, a couple of million in revenue. Particularly the VCs we're talking about, because they don't really, they know where most of the failure in the process is actually at the start. It's actually in the idea stage, it's in the first MVP. Whereas that's why an angel investor comes in. That's where, you know, potentially looking at friends and family investments, etc.
And the VCs are inundated with so many options. But look, at the end of the day, 97% of apps fail, and it comes down to two things: lack of world-class execution and lack of strategization. And I think those two go hand in hand with seeking capital as well. So look, what I might do is we'll throw up a link to Guy Kiyosaki as well for the people listening.
Yeah, we'll post that on our Facebook page after this meeting. So that's pretty much it from us. Like I said, thank you so much for all coming along. I know we've had a couple of sound issues on this, so it's ironic because you won't be able to hear me say that if you can't hear the sound. But we'll be posting a copy of this pretty soon out, and we'll probably post that on our YouTube channel. Thank you everyone who came, and like I said, one other thing I'll add before we go is if you're interested in working with Appster and, you know, helping connect you to potential investors, or actually getting you know, someone to assist in the capital raising process, it would be fantastic if you could send an email through to dane@appster.com.au, because that's a new focus at Appster right now. We're really focusing on how do we actually get get clients through to the next stage. You know, we can make incredible apps, but it's actually a big deal for clients to get funded. And I know some clients get funded very easily, and some people really struggle. That's something we've noticed over the last couple of years, and we're very keen on figuring out, you know, how we're going to help clients. And basically, we've got some very interesting stuff in this space that's coming out shortly. But like I said, if you're interested in, you know, a way for you to go through the investor stage, maybe it is reaching out to these kind of investors, maybe it is helping people get that debt financing, maybe it is a number of these different ways to get your idea off the ground. You know, contact Dane, because he'll get you in touch with our capital raising team. A lot of their services are actually free. You know, if you're an existing client, they'll help you get to the next stage of development, because it's in our best interest to help you find investment. So send through some of your details if you want.
And just touching on that, we're also implementing an investor-ready workshop as well. So if you guys need any more information about that, I'm more than happy to supply that for you. But look, thanks so much for that, Mark. I really appreciate it. I think there's some very valuable information for the people in that conceptual stage. But
yeah, thank you so much for having me, and guys, thanks so much for coming. We really appreciate that, and yeah, we look forward to seeing you on the next webinar.
Until next time.
Thanks so much, guys.
Bye.